So while everyone's been glued to stocks and crypto, something really strange has been happening in the silver market. We're about to dig into one of the biggest disconnects I have seen in years and really break down what it could mean. Okay, check this out. Since late 2024, the price of physical silver has just gone vertical. We're talking an incredible 296% surge, from around 29 bucks an ounce to over 114. I mean, that is a historic move, plain and simple.
But here is where it gets weird. The companies that actually pull this stuff out of the ground, the silver miners, they're only up 36% in that same time. You'd think they'd be absolutely printing money, but the market is basically shrugging its shoulders.
And this chart just lays it all out. We're looking at a 260 percentage point performance gap between the metal and the miners. This isn't just a little discrepancy, it's a massive gulf. So what on earth is going on here?
To understand this, we have to solve what I'm calling the byproduct puzzle. Now, this is the key that unlocks this entire mystery, and it's a dynamic that most investors completely miss when they think about a metal like silver.
It's the most logical question in the world, right? If the product you sell suddenly quadruples in price, you make more of it. That's business 101. But silver, well, silver doesn't play by those rules, and the reason why is the real aha moment in all of this.
And here it is. A staggering 70% of all silver that gets mined comes out of the ground as a byproduct of mining for other metals. We're talking copper, zinc, and lead. This means it's just a secondary metal in mines that are really looking for something else. Only 30% comes from mines where silver is the main event.
So here's the crucial point. A copper mine's decision to produce more is based on the price of copper, not silver. The silver is just a nice little bonus. So when silver prices go crazy, there isn't some magic button they can push to get more. The supply is basically fixed. It can't really respond to these price signals.
And this really shows you the problem. Despite a nearly 300% price incentive, global mine supply has stayed stubbornly flat. The market is screaming for more silver, but the mining industry's hands are tied. Now let's build on this, because this static supply is crashing head-on into a demand that's growing fast. And this is where the story shifts from just being interesting to, well, potentially urgent.
For 5 straight years, the world has used more silver than it has produced. And look, this isn't a one-off thing. It's a deep structural imbalance that's been building for a while now. The scale of this is just mind-boggling. Since 2021, the total deficit has hit 820 million ounces. To put that into perspective for you, that is like an entire year of global mine production that has simply vanished from inventories just to meet demand.
So, where's all this silver going? The main driver is industrial demand. And I'd call it non-negotiable demand, because you literally can't build a solar panel, an electric vehicle, or certain AI components without it. Solar panels alone ate up over 230 million ounces last year. This isn't some speculative frenzy. It's structural, and it's flipped industrial use to almost 60% of all consumption, way up from 35% back in 1980.
The only way the market has been able to function is by raiding the warehouse, so to speak. These above-ground stockpiles are being relentlessly drained. COMEX, which is a huge hub for physical silver, has seen its inventories plummet by 70% since 2020. This is just not sustainable.
Okay, so with that backdrop of inelastic supply and ravenous demand, let's look at the bull case. Why do some investors see this as the trade of a lifetime?
It really boils down to this one powerful idea. The market is pricing the companies that produce silver as if the price were half of what it actually is today. There is this profound disbelief baked right into these stock prices. And we're not talking about struggling companies here. They're trading at rock-bottom valuations of like 4 to 6 times earnings. They're generating a ton of cash. We're talking 10 to 15% of their stock price in pure profit every year. And historically, when these miners finally do catch up to the metal's price, they don't just match it, they often surge 2 to 3 times the gains of the commodity itself.
Now, let's be totally honest about the risks. This wouldn't be a complete analysis if we didn't look at the other side. There are very real reasons why the market is this skeptical.
Silver's 63% gain just this year absolutely fits the definition of a parabolic move. And as history shows us, moves like this are often followed by sharp, painful corrections. The history books are filled with assets that made moves just like this right before a major downturn.
And here's another warning sign that analysts are pointing to. The annualized silver lease rate, which is basically the interest rate you'd pay to borrow physical silver, has spiked to 39%. That's the highest it has been since the wild market of 1980, and it signals extreme tightness and maybe even stress in the physical market.
So you've got this head-to-head debate. The skeptics see a classic speculative bubble that's going to pop if a recession hits. The bulls counter that no, this time is different. It's driven by real industrial demand, and the supply just can't respond no matter what happens with the broader economy.
Which brings us right back to where we started, to that central mystery. We've got all the pieces of the puzzle on the table now.
The situation is pretty stark, really. This is the widest gap we've seen between the metal and its miners in decades. One of two things has to happen. Either the price of silver is going to come crashing down, proving the stock market right all along, or these miners are on the verge of a historic, violent catch-up rally.
And that's the bottom line. Is this massive disconnect the glaring opportunity that the market, in all its distraction, has completely overlooked, or is it a dangerous trap that smart money is rightly and wisely avoiding? Well, that is the billion-dollar question.